Thank you, Mr. Chairman, and thank you to our guests. Mr. Chairman, a question I've asked you in several consecutive hearings. The COVID-19 pandemic, of course, the most significant shock to the U.S. and global economy in the last 2 years. Beyond COVID, what do you assess are the most significant systemic risks or threats to financial stability in the U.S. and globally? Thank you, Mr. Chairman, and thank you to our guests.
When I think about systemic risks,
Mr. Chairman, a question I've asked you in
I
several
always think about
consecutive hearings.
cyber risks, really more than anything else.
COVID-19
We have a
pandemic,
very highly
of course, the
capitalized
most
banking
significant
system,
shock
one that
to
is
the
much
U.S. and
better
global
at measuring
economy.
its risks, so that more traditional making bad loans, losing money, and things like that, that'll happen, but the banks are really well fortified against that. The risk that we haven't
to the U.S. and global economy in the last 2 years. Beyond COVID, what do you assess are the most significant systemic risks or threats to financial stability in the U.S. and globally?
When I think about systemic risks to the financial system, I always think about cyber risks, really more than anything else. We have a very highly capitalized banking system, one that is much better at measuring its risks, so that more traditional making bad loans, losing money, and things like that, that'll happen, but the banks are really well fortified against that. The risk that we haven't really faced the full brunt of yet is a successful cyber attack on a financial institution of some kind, be it a financial market utility or a bank or another financial institution. And you know, we work closely with Treasury and other agencies all around the country on that. You never have the feeling you're doing enough, but it's a very high priority to be ready for it. But that would be the number one thing.
Madam Secretary, the same question for you, please. Other than the ongoing COVID-19 pandemic and the terrible economic toll that it's taking and the terrible health toll that it's taking, looking more broadly, what do you assess to be the most significant systemic risks or threats to financial stability?
I think there are threats to financial stability that have come from the growth of activity in the shadow banking sector. We saw some of those threats emerge during the onset of the pandemic. We have, for example, open-end bond funds that guarantee daily redemption, saw massive withdrawals by individuals who wanted to flee to cash, and that can trigger fire sales of assets with systemic consequences. The Financial Stability Oversight Council that I head has taken that up as a topic that we're looking at and examining. There are issues relating to hedge funds and the possibility of leverage there that can trigger financial runs.
Ladies and gentlemen, as you can see, this is a testimony in front of Congress by Janet Yellen during the CARES Act testimony back in 2021, September of 2021. She tells us very clearly that there are massive risks in the shadow banking sector, including hedge funds and money market funds, that threaten the financial stability of the entire world. Ladies and gentlemen, they are extremely over-leveraged, and this cannot continue forever. What we're seeing today is an absolute disgusting 3 standard deviations above the 50-day moving average. So we have 3 sigma events here, 3 standard deviations above the 50 daily moving average. This is not good at all for market breadth whatsoever. Breadth with a B-R-E-D-T-H. Now, you can see here that Jeremy Grantham said a 2 sigma is the kind of deviation that should occur every 44 years. Because we're a little wilder and less efficient than we should be, it happens every 35 years. Every 35 years feels about right. 1 event in a career and twice in a lifetime. 3 sigma events should occur once every 100 years. Now, as I like to say, do crazy pretty well as a species. Therefore, 3 sigma events occur much more often than they should, and they are out of kilter much more than 2 sigma events. With 2 sigma events, you can have some reasonably standard bubbles, says Jeremy Grantham. He's the co-founder and chief investment strategist of Grantham, Mayo, and Van Otterloo, GMO. He said, they give you a standard amount of pain in the minus 30, 40 to 50% area. Super bubbles can pretty much wipe you out like 1929. And that's where we are now. Ladies and gentlemen, you are looking at a massive 3 sigma event occurring right now on the S&P tech sector, the S&P 500 information technology sector, SPT. The fact that it is in 3 sigma deviations basically means that it is in the 99.7 percentile in reversion to the mean. The mean being, say, near the average, if you will. It's basically a mathematical rule that states that almost all returns fall between these 3 standard deviations of the mean in a normal return distribution. So 2 sigma events happen less frequently, about 27% of the time, and 3 sigma moves rarely occur. Around 99.7% of the time they do not. So that's about 0.3% of the time when they actually do occur. And those should not occur, but maybe every 100 years. And we're looking at that happening right now on the S&P 500, in the tech sector, in the SPT. What else is noteworthy? The only other times that the tech sector has surged over 4% while overall stocks declined was at the onset and at the middle of the tech bust in April of 2000 and March of 2001. The market is in extremely bad health, and it's going, for the most part, unnoticed by the majority of retail investors. The S&P 500 closed at the highest level in 9 months since August of 2022, and the NASDAQ is at 52-week highs. So headlines right now read like we're in a bull market, but I'm fairly certain that it's not. Market breadth is absolutely atrocious. Stocks are making more new lows than they are making new highs. This is a highly concentrated rally, which is uncharacteristic of rallies that end bear markets. Those rallies that end bear markets exhibit improving market breadth. Sentiment right now is absolutely fading while prices are rising, and in this bear market, sentiment peaks have preceded all declines. Peaks of sentiment have preceded every single decline. This vibe that we have going on of AI anything on Wall Street is absolute euphoria. It's the hallmark of euphoria. And I think it's going to be very obvious in hindsight. Right now we've got issues with debt ceiling talks, rate hikes, and the Federal Reserve tranquilizing market participants. The news cycle that we're currently seeing prior was the coronavirus narrative and the ongoing war story now with Russia and Ukraine. Participants in the market are absolutely numb. So sharing the history, it shows that if the S&P 500 can advance 5% above the long-term moving average, the 200-day exponential moving average, it is most probable that the bottom is in and the genuine market recovery is underway. However, this has yet to happen after multiple attempts by the S&P 500, and I remain doubtful that it will happen, considering the absolutely horrendous market breadth, the fading sentiment, and the numb participants in the stock market. So if the S&P 500 technically, using technical analysis, can break the 5% long-term moving average threshold for a week, I may have to reevaluate my market outlook, but until then, I remain absolutely bearish, even though we're having a bull run in a bear market. Politico here is saying some really interesting things. Negotiators are aiming for a weekend deal to avert the debt default. And you may wonder why this is important. Well, it's because the market doesn't crash usually because of a default. It crashes after the debt ceiling has been raised. The market doesn't crash if there's a default because there likely won't be one. If there would be, I would suspect that Democrats would be holding our economy hostage and blaming it on the Republicans and in order to increase the amount of spending that they're going to be able to have. At the same time, Republicans could hold back and force a default by the Democrats in order to better their chances of winning the 2024 election. But what we're seeing here briefly, I'm about to just read this briefly and then we'll touch on exactly how the market crashes after the debt ceiling is raised, because Jerome Powell tells us. And I'll show you that video here in a moment. So the White House and GOP negotiators are closing in on an agreement to lift the nation's debt limit, with both sides predicting a deal could come together as soon as this weekend. Okay? President Joe Biden publicly predicted the proof of such a deal could emerge before midnight, but one GOP negotiator was slightly more cautious in the timeline, though he also sounded upbeat. He said, "I'm hopeful," according to Chair Patrick McHenry. He said, "But we have to make sure we're aligned on text, aligned on agreements. There are significant challenges ahead, and I don't know whether that's hours or days." All right. Now we've got Treasury Secretary Janet Yellen informing Speaker Kevin McCarthy that the borrowing limit will run out on June 5th. She had previously said June 1st. Now it has been pushed back to June 5th as they are undergoing extraordinary measures to continue to be able to pay the bills. And they have less than $46 billion left, whereas last week they had about $96 billion. Yet even with those extra days, McHenry insisted negotiators were pressing ahead with just as much urgency as they seek a final agreement with the White House, amid pressure across Washington and Wall Street. And of course, they're met with skepticism on this. See, but the two sides have supposedly all but finalized the spending portions of discussions. However, also on the table is a new procedure in place to incentivize Congress to pass all 12 spending bills and plan to claw back unspent COVID money. So, looks like Biden is going to Camp David and is very optimistic, says, "I hope we'll have some clear evidence tonight before the clock strikes 12 that we'll have a deal." But it doesn't really appear to be the case. McCarthy, however, has downplayed the criticism from the right, saying that they don't know what is in the deal, period. But if you look here, work requirements and permitting reform remain two major sticking points for them. The White House, according to a person familiar, says is continuing to push against measures that they are concerned would drive Americans into poverty or take their health care away. But Republicans are accusing the White House of digging in and wanting to pay people who are able-bodied with no dependents to stay home. Right now, this is what they're saying. Representative Garrett Graves, the Republican from Louisiana, says Democrats now are willing to default on the debt so they can continue making welfare payments for people that are refusing to work. And I'm talking about people that are without dependents, people that are able-bodied between 18 and 55. And asked if Republicans were willing to drop work requirements, Graves added, "Hell no." And it was still an issue as of this evening. This is a brand new article here by Politico, just posted. So what we have here is House Republicans are threatening to trigger an unprecedented recession and cost the American people over 8 million jobs unless they can take food out of the mouths of hungry Americans, says White House spokesperson Andrew Bates, citing GOP demands for, quote, new additional work requirements designed to tie the most vulnerable up in bureaucratic paperwork, which have shown no benefit for bringing more people into the workforce. Ladies and gentlemen, if you ask me, they're nowhere near. They're nowhere near a deal right now, even though they're giving the bullshit that they are. But take a look at what Finance Lancelot posted. Jerome Powell said the quiet part out loud back in 2011. When they pass the debt ceiling, the U.S. government needs to create chaos in Europe and the stock market, to drive up demand for all the newly issued government bonds. This has always been the plan. So when they raise the debt ceiling, that's usually when markets collapse and chaos ensues throughout Europe and the stock market in order to get people to buy the bonds that the government is selling. And after this little charade with the debt ceiling, they're going to have to sell a metric shit ton of bonds, billions of dollars worth. Check this out. This is 2 minutes and 20 seconds of absolute fire from Jerome Powell.
Washington Journal continues.
So it's literally unprecedented. We've had many debt limit impasses going back 25 or 30 years, but we've never crossed this, what is the August 2 date, and gone into a situation where the government no longer has enough cash to pay all.
See, now this was in 2011. And if you don't remember what happened in the stock market, I clearly remember what happened. And the market took a giant, massive dump. It was disgusting. And we are looking at a worst market breadth and situation and super bubble that we have not seen in decades. Look at how young Jerome Powell was in 2011 when he was saying this exact thing. He tells us exactly what's happening right now in August of 2011, right before the market tanked, is happening at this very moment.
30 years, but we've never crossed this, what is the August 2 date, and gone into a situation where the government no longer has enough cash to pay all of its bills. So there's no roadmap, there's no rule book, none of those things. So they would have been examining basic things like the legal question: do they actually have the authority to choose to pay bills in anything but the order in which they're due? It's not at all clear that they do. There's no statute that says, we've ordered you to spend this money, Congress has, but we haven't, but in case we don't give you the money to do that, you should do it in the following order, or you should make up your own mind. So Treasury might actually have concluded that it didn't have legal authority to pick one over another and would just pay the bills in chronological order out of available cash flow. Or it may have decided, I hope we never find out, but it may have decided that it did have that ability, and that it would pick Social Security and payment for the troops and things like that, which really must be paid. But again, I hope we never find out the answer.
Speculating on what will happen next.
So bad economic news drives people out of stocks and into bonds. And when people go into bonds, they bid up the price of bonds, and that bids down the interest rate that the government is required to pay. So that's what's happening now. We had bad economic news last week. Another thing that drives people into our bonds is the turmoil in Europe, as it becomes more and more clear that the Europeans have not figured out what to do with the potential default of some of their major nations. And so global money tends to come into Treasury securities at that time. So that's what's going on. Now, the market is clearly pricing in a successful vote on the part of the House and the Senate. Stock markets were up. I haven't looked since I got on the air, obviously, but stock markets were up all over the world as soon as the president made his announcement last night. So, if the bill does pass, it'll be, at least in the short term, good for the stock market as well.
Take a look there. This is what happened. The stock market was up that day, and this is what happened when the debt ceiling was passed. On the S&P 500 E-mini futures, going down from about 1320, 1340 within a matter of a couple days, all the way down to 1080. This is S&P 500 E-mini futures when the debt ceiling was passed in August of 2011, when the government was running out of money, just like they are right now. Right now, we're seeing U.S. Treasury credit default swaps at the highest level we have ever seen them. NASDAQ call volume is the highest it's been in 8 years. Bank deposits and M2 money supply are experiencing the most severe drop since 1929. Look at the U.S. one-year credit default swap in 2022. Absolutely astronomically priced. Look at the NDX daily call volume. Highest it's been since January of 2014 actually. The highest in 8 years. Look at bank deposits from their peak. Bank deposits are experiencing the most severe drop that they have seen since 1975. The M2 money supply, the velocity of money, is experiencing the most severe drop it has seen since 1929. And a sudden reversal in these could trigger the greatest market correction we have seen in 90 years. Chapter 11 filings by indebted companies have jumped in May, including 5 that occurred during a 24-hour span for large U.S. bankruptcies by month. Number of new Chapter 11 filings has continued to increase month over month practically. Higher highs, higher lows. These are companies reporting liabilities greater than $500 million. Take a look at this chart. It is absolutely gross. When it's reversed, when it's made in such a long time frame here, from the 50s all the way through today, these drops look fairly minuscule. But look at the RSI. Look at the drop in M2 money supply. It is absolutely gross when you see it like this. What do you see? Here we saw the early 90s, late 80s, early 90s crash, the 2000s crash, the 2004 market drawdowns, 2008 and 2009 great financial crisis. Looks absolutely minuscule to the reduction in M2 money supply and velocity of money that we're seeing right now. We are in the absolute thick of it. Thank you, MC. Thank you, Ricky Ray, for the super chats. You guys are too kind. You don't have to super chat me, but it is greatly appreciated. To answer your question, that's a print. That's a print that I got a long while back. I really like that one here. At the bottom it says, "Why so genius?" And that's, of course, Albert Einstein in the form of the Joker. Now, you see, 99% of people really don't understand why recessions occur. And the absolute basics are that in almost all countries around the world, banks take deposits from their customers. And when you make a deposit at a bank, the bank offers you interest rate as an incentive for keeping your money deposited. That agreement to receive interest allows the bank to lend out a certain portion of your money to other customers. Banks generate profits by lending your money to borrowers at a higher interest rate than what they're offering you. When you deposit money in your account, the bank puts it into a pool of money from all the depositors. And if you want to withdraw money, the bank takes it out of the pool and decreases their liability to you, which is your bank balance. Because your balance is a liability to the bank because they invest your money right away the second it goes in there. To pay interest to depositors, banks use deposits to earn interest by lending it to customers that want to borrow money. So banks are an intermediary for people that want to lend their savings and to other people that look to borrow those savings. So you have to work to make money and earn interest on your savings, while banks make profits because they can create money out of thin air. This is fractional reserve banking. And fractional reserve banking makes it so that they can lend more than the amount of cash that they actually have. Lending creates new money out of thin air. Your mortgage on your home is an example of a loan created through fractional reserve banking. Think of it like this. A bank has $100,000 in deposits. It lends 90% of the money to someone that wants to buy a home. Now there's $190,000 magically in the system that they printed out of thin air. So the money held by depositors is still available to be withdrawn, as you can see here, by bank deposits from the peak. And depositors' accounts still hold that amount. So the newly created money expands the economy, but also leads to inflation because more money is competing for the same amount of goods. The process of borrowing and lending this money is the main reason for the debt cycles that we're currently seeing. And a debt cycle begins when we start living beyond our means and spend more than we can afford. And that's exactly what the United States government is doing. Take a look at the U.S. debt clock. It's an absolute disgusting thing. The U.S. national debt is at $31,808,603,200-something thousand and climbing. Absolutely astronomical. A central bank is basically a national bank that provides services to the country's government. So the goal of the central bank is to achieve low inflation via price stability. And the main tool that they have to achieve these rates, these goal is interest rates. That's the main tool, is raising interest rates. That's why the Fed is working so hard on trying to raise and raise and raise. So central banks control debt cycles by increasing and decreasing the interest rates for you, the borrower. And the cycles lead to massive booms and busts and badly impact the average citizen who may lose their job and their ability to pay for necessities. That's why Jerome Powell is looking at unemployment numbers to go up, because they want people to lose their jobs and lose their homes in order to reduce inflation. So, because recessions occur because in a fractional reserve banking system, recessions and depressions are normal. Okay? Fractional reserve banking leads to overly leveraged positions, like we're seeing right now with those hedge funds and shadow banks, the money market funds that Janet Yellen just told you about. And recessions wash those out of the system. Since March of 2020, banks have no reserve requirements, which means they can lend out everything they receive as deposits. That's why we're seeing things like Silvergate and SVB and other banks having these bank runs, because they do not have any cash. They lent it all out. So a recession occurs when the GDP, the gross domestic product, decreases for 2 quarters in a row. We have now seen that Germany has gone ahead and revised their numbers for last quarter, and that now, after the fact, officially confirmed that Germany is in a recession. The United States will most likely do the same. They are always wrong about their estimations, and they always come back and reduce their revisions after the fact. The opposite of a recession is an expansion, an increase in the level of economic activity and GDP. And if central banks want an expansionary period, they decrease interest rates to increase borrowing and investing, like we saw after 2008 all the way to today. And if they want to trigger a recession intentionally to reduce inflation, they can increase rates to decrease borrowing and increase unemployment. And for every 1% that unemployment goes up in the United States of America, 40,000 people die. So when inflation gets too high, central banks increase interest rates to decrease consumption and investment. These are the same corporations that borrow too much aren't able to pay back their loans, so they default on their debts. And everything is interconnected in our economy, and companies lend assets amongst themselves. These defaults lead to ripple effects throughout the economy and financial markets around the world. And the average person suffers because corporate defaults on loans lead to bankruptcies. And bankruptcies lead to job losses. And job losses lead to defaults on consumer debt and debt to purchase assets like homes. And defaults on consumer debt and debt to purchase assets like homes lead to bank runs, and so on. It's a vicious cycle. And those lead to over-leveraged hedge funds, money market funds, pensions, and 401ks getting drained. And heavily shorted stocks like precious metals and meme stocks oftentimes go to the fucking moon. So debt cycles like this are a lot more painful when interest rates go up quickly. That's why the Fed is trying to make them go up slowly. But it's insufficient. Inflation is trending, and it is not transitory. It is here to stay unless more people become unemployed. And like I said, for every 1% of unemployment in America, 40,000 people will die. Recessions make it so that instead of only a few houses going on the market, a lot of them are sold quickly to pay off their debts. Decreasing housing prices leads to panic selling in the real estate market and a wave of houses being sold. Interest rates go up, which leads to a stronger currency and a decreased appetite for risk because interest rates are higher than returns on risk assets. More borrowers need the currency to make debt payments, which are now larger due to higher interest rates. And people will want to buy bonds that the federal government is selling. That is why Jerome Powell told us back in 2011, right before the stock market collapsed during the debt ceiling crisis, and it's the exact same thing we're seeing right now with the June 5th new deadline set by Janet Yellen. And these shadow banks and hedge funds lead to the possibility of financial runs and instability in the financial sector worldwide. That being said, what does that mean for holders of precious metals and meme stocks? Well, in my opinion, I think we're going to be filthy fucking rich if you're properly hedged. Whatever that might mean to you might be different from what it means to somebody else or to myself. I'm not here to give you financial advice, and none of what I say should be considered financial advice of any kind. You need to figure out what's best for your situation. I am heavily leveraged in cash, precious metals, meme stocks, tangible assets, and even real estate. And I will be changing some of those hedges, mainly real estate, because it's time. The top in the real estate market for the foreseeable future has arrived. And it has come and gone. And we are now trending downwards in real estate. And the 3 Sigma event that we're seeing right now in the S&P 500 is just that. It is a super bubble. When we are 3 standard deviations above the 50-day moving average, that is a 0.3% chance of occurrence. I foresee absolute and utter pain coming in the stock market in the coming future. But again, I'm not a financial advisor. Do your own due diligence and figure out what works for yourself. This new debt cycle that we've been discussing, well, ladies and gentlemen, what will that usher in? That will usher in bailouts in the form of central bank digital currencies, and stimulus in the form of CBDCs, and welfare, and so on. So if you want welfare or unemployment checks or stimulus, or if you even want to pay your mortgage, you're going to have to do it in central bank digital coins. If you want your tax rebate, if you want to pay your property taxes, anything of the sort, if you want to get, you will have to do it with central bank digital currencies. This is the way they force you into their system. Luckily for me, there are certain things out there like highly over-leveraged hedge funds and money market funds and prime brokers that have spent way too much money naked shorting and creating synthetic shares of meme stocks and precious metals, such as silver and gold and AMC and GameStop and so on. That being said, I'm excited to talk about AMC. The judge that is working on the case right now for AMC has upheld a trading ban for investors who view court files and oppose the settlement and conversion of APE to AMC. They will be prohibited from trading to prevent insider trading and other issues, regardless of the stock price. The shareholders that are suing AMC have asked the judge to rethink confidentiality conditions. But the judge says AMC's legitimate concerns justify these restrictions. Therefore, investors who go online and view the confidential court files related to a 9-figure legal settlement must pledge to refrain from trading AMC securities until after the case has been closed. That being said, even shorts such as Andrew Hahn, the co-owner of Ursa Fund Management, has been begging the judge not to let AMC proceed with the conversion of the reverse split. And I allege that this is because he knows that he will have to buy a shitload of fucking shares of APE, AMC's preferred equity shares, and AMC stock, AMC common stock, in order to close out his position, or at least a portion of it, to maintain his margin position. Because a lot of retail investors will see the dilution occurring, and that last 2 times that has occurred, it has caused AMC's price to increase with great volatility and very quickly, leading to a June 2021 run-up of $77, $78 on AMC stock. But now, with the conversion of APE to AMC and the closing of that QSIP and the name change from APE to AMC and the reverse split after the 1-to-1 conversion of APE to AMC and the reverse split of 1 to 10 shares, there will be much fewer shares available, 10 times fewer shares available for them to purchase, meaning that they will be more expensive to borrow. The cost to borrow will go up. Actually locating the shares will become exponentially more difficult. And the gamma possibilities from the exercising of call contracts would most likely lead to a plethora of problems for these short sellers, including but not limited to mass bankruptcies and domino bankruptcies across hedge funds, family offices, broker-dealers, prime brokers, and so on, all the way up to the clearinghouses like Apex and so on, and other clearing as well, other clearinghouses like maybe even Citadel, market makers, Susquehanna, Virtue, State Street, prime brokers, market makers, hedge funds, family offices that have naked shorted, created too many synthetic shares, rehypothecations, tokenized securities with no underlying assets, as there should be, are going to cause a massive problem for them. In case you missed it, hedge fund manager Andrew Hahn and Ursa Fund Management only have 900 shares of AMC, but they have 11 million AMC puts. And he wrote to Chancellor Zern, urging her to deny the settlement and not allow the reverse split and the conversion. It couldn't be more clear what's going on. I know what side I'm on, says America. And I know what side I'm on as well. Because what's happening is they only have 900 shares, which is nothing for a hedge fund. I have tens of thousands of shares. How about you? How many shares do you have? Put it in the chat right now. Put it in the comments right now. Let me know how many fucking shares of APE and AMC do you have? You're not obligated to answer. This is not financial advice. But if you're feeling froggy, go ahead and drop it in there. These assholes have 900 shares of AMC simply so that they can sue AMC, and that is exactly what they tried to do. They're trying to delay the reverse split and the conversion because the closing of the QSIP number for APE to AMC and the name change of APE to AMC and the conversion 1-to-1 of APE to AMC and the 1-to-10 reverse split of AMC afterwards and the selling of shares by AMC is very highly likely to lead to a gamma squeeze and buybacks of shares by broker-dealers and hedge funds and FOMO buying by retail investors and the price going up and up and up and up and up and up and down and down and up and up and down and up and up and down and up, etc. With very many limit up, limit down halts in that same sense. I'm seeing all those fucking numbers over there and I am astounded at how many fucking shares you guys have. Almost every single person that has put how many shares they have right now has more shares than these fucking assholes. And I am ecstatic to see that. I'm looking 23,000, 2,000, 1,500, 2,700, 1,800, 2,000, 10,000, 6,000 shares, 16,000 APE, 3,500 AMC, 3,400 APE, 3,400 AMC, 3,500 APE, 4,600, 13,000 combined shares, 22,000 APE shares, says Steven, 21,000 AMC shares. Put your shares in the chat. Let's see how many do you have compared to this hedge fund that is trying to sue AMC to delay the reverse split and the conversion because Andrew Hahn knows that he's about to get fucked. And as you can see from Dade Murphy, Naked Jockman, always appreciate his posts on Twitter. He posts the filed, stamped documents directly from Vice Chancellor Zern and, directly from Andrew Hahn to Vice Chancellor Zern. And he says, so a fund that is openly short AMC with 11 million puts and only 900 shares, so 11 million puts each equal to 100 shares underlying. So what's that, 111 million shares short, basically, if you convert it into the number of shares for those 11 million puts. They wrote a letter to the court in opposition to the conversion and reverse split, and they have 900 long shares. Hey, Dade, I think this means we're going to be so fucking rich. That's what I think it means. So the AMC judge has upheld the trading ban for investors who view these court files. I'm not going to view them. I have no interest in viewing them anyway. But the reason being, because it may allow people to have insider information that would allow them to manipulate the stock, or hedge funds to manipulate the stock, etc. But I'm seeing a lot of fucking shares available out there, and I'm not surprised in the slightest bit. Ladies and gentlemen, make sure you're properly hedged. Make sure you're prepared for the inflation that is coming, the inflation that has been here, and the inflation that will continue to be ongoing for a period of time. Because when that inflation finally turns into deflation, we're going to be looking at stagflation. That's what we're starting to see right now in this economy. A stagnant economy that is still succumbing to inflation. That being said, ladies and gentlemen, my name is Marcel Kalinovic. If you'd like to learn more about a broker-dealer that we're working on, we expect to launch before Christmas of this year, pending our licensure, receiving our licensure from FINRA. Once that occurs, we are in the approval and development stages right now, and we are going to be offering you the chance to invest in the company via our Founders Program. So if you'd like to learn more, go to litexchange.com, litxchange.com, and you can put your email in to become a beta tester, to get more information and updates about our broker-dealer when it launches, or to become an investor in the company. Because I don't want to go to venture capitalists to be able to buy our company or give them equity portions of the company. I would rather let retail invest in the company themselves, because this is a broker-dealer for retail investors by retail investors. And when I got into the AMC and GameStop and all these other meme stocks, I had no intentions whatsoever of creating a broker-dealer in the stock market. None whatsoever. But I started thinking to myself, what can we do to actually make a difference in the stock market? Well, we could create our own market makers. We could create our own hedge funds. We can create our own broker-dealers. And I started thinking, what could we do here? Well, retail can't trade on dark pools, even though large institutions can run your orders through dark pools. But as a broker-dealer, we could help retail investors run their orders directly through lit markets and lit exchanges like IEX, Investors Exchange, like the NYSE, New York Stock Exchange, instead of giving them to broker-dealers like Robinhood and Webull and others that send your, in public, that send your orders via payment for order flow to market makers for them to front run your trades, and then to take your shares that you were buying or selling and run them through the OTC, over-the-counter trades, where they do not hit the national best bid and offer, where they do not make a actual price impact as if they would if they were run directly to lit markets. In addition, we're going to be having some very good tools that I think people are going to be extremely excited about. So I'd like to offer you the opportunity to invest in Lit Exchange, and that will be coming in the near future. You can go to litexchange.com to learn more. Hedge yourself, act accordingly. Thank you, everybody. I wish you peace and wealth. Act accordingly. Have a great weekend, my friends. Gonna be so goddamn rich.
I think it's time to blow this thing. Get everybody in the stuff together. Okay, 3, 2, 1, let's go.
Gonna be fucking rich. I want my fucking money. Griffin, I want my fucking money. motherfucker. Holy shit, we're gonna be so fucking rich. Great. Damn it, we're gonna be so fucking rich. Griffin, I want my fucking money.
You're an original,
Hey,
aren't you?
Yellen, give me the fucking money.